And I think a lot of people see the same thing I see that I don't think Powell yet sees, which is that the economy's weak and about to get a lot weaker. When you look at
Mhm.
housing, you look at the inventories in the Walmarts and Targets of the world. You look at some of the regional Fed numbers, et cetera. It's all pointing to certainly an inventory correction and I think a lot of weakness. So I think people are adding two and two and saying, Powell's may not yet understand how weak things are, but between now and September, there's going to be a lot of data that's going to point him in that direction.
Welcome to Gold Silver Pros, where you'll learn the ins and outs of the gold and silver markets. Searching for the best precious metals deal? Our affiliates are of the utmost trust, quality, and highest customer service in the industry. Shop with our trusted partner, �ル𝙀. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hey everybody, this is Rob Kientz with goldsilverpros.com. It is July 28, 2022. I think we're going to have this one out the same day that we record it because we have returning one of the most popular guests on the show, David Hunter, who runs the Contrarian Macro Strategist. You can find him on Twitter at Dave H. Contrarian. Dave, how are you doing today?
Hey, Rob, how are you?
I'm doing very, very well. And I wanted to have you on right now because I think it's the perfect time to follow back up on what we talked about last time. And what we talked about earlier this year, David, was how the markets could correct and maybe come back for another stage called the melt up. And I'll let you get into all of that theory here in a moment because I know the way the markets are right now definitely isn't where they were a year ago. But I wanted to start with a tweet that you had out. Actually, you put this out today, early this morning. And the tweet reads, and let me actually put it up on screen here, David, for people to follow along if they want.
Sure.
You said investors are parsing Powell's words, determine if he is getting close to a pivot. What I heard yesterday was a continued focus on inflation and still a lack of awareness of the deep recession that's coming. I suspect that will change between now and the September meeting as data worsens. So, and this got a lot of play today so far, David, on people trying to clarify what's coming. Is it going to be the melt up? Is it going to be a crash? Explain what you think is going to happen for the rest of the year.
Sure. In terms of that tweet, basically, it was clear to me. I mean, the market ran with his comments yesterday, and I heard a lot of talk that people are saying, he's really showing that he's ready to pivot or starting to ease up on things. I didn't hear that so much. I think what may have gotten the market going or gotten people a little excited is that he said we're no longer giving forward guidance
Mhm.
and we're going to go meeting to meeting. And I think a lot of people see the same thing I see that I don't think Powell yet sees, which is that the economy's weak and about to get a lot weaker. When you look at
Mhm.
housing, you look at the inventories in the Walmarts and Targets of the world. You look at some of the regional Fed numbers, et cetera. It's all pointing to certainly an inventory correction and I think a lot of weakness. So I think people are adding two and two and saying, Powell's may not yet understand how weak things are, but between now and September, there's going to be a lot of data that's going to point him in that direction, which probably means we may have seen, even though he said no, or likely no, I think we may have seen the last hike for a while. And
You
I
think
have a
so?
feeling, yeah, I mean, he could hike in September, but if the weakness is as much as I think it is going to be in the next 2 months, they're probably going to pause. I don't know about a true pivot, but I think a pause is coming. So that may be what the market's sniffing out. I'm not sure. But I do, I've been pretty critical of Powell because I think he is so, as I said in another tweet, he got burnt by his whole transitory focus on inflation
Mhm.
at the end of last year, and then he's been playing catch up all this year. And I think he's just overly focused on inflation because it hurt his credibility. And I think as a result, that plus the Fed's tendency to look at headline data, which is backward looking, I think he's missing all the signals that are forward looking, leading indicator type signals saying, yeah, things are slowing down, but they're about to get a lot slower. And as a result, I think he's going to be, as the Fed always seems to be, a little late to the party, a little late to the recognition. And, it's not a question of whether they'll catch up. I just think they're over tightening as a result.
Yeah, it seems as though they almost knee-jerk reacted because they started with a quarter, and then they hit, what was it, 0.75, 0.75. Well, it was 0.5 first, and then, I mean, they just kept going up and
Yeah.
accelerating, and you could tell that they were reacting to the market. It was all the talking heads talking about, oh no, we have high inflation.
Yeah.
I
If you look,
suspect that the high inflation, something I put on the show recently, I suspect that the high inflation is reducing the impact of all those dollars they printed because it reduces the purchasing power, right? So do you think that they're caught in a trap where they're going to have to ease again because they have a reduced effectiveness of what they did 2 years ago? Is that what it is? Or do you think he's just blind to what's really going on?
I think he's blind to what's going on. I mean, I think he thinks he's going to engineer a soft landing. And
Mm-hmm.
I think we've already moved, as I say, the seeds are sown for a global bust. I think we've already moved past a soft landing in terms of policy. And again, that seems funny to say when you're only at, 2.5 interest rates. I mean, but the the bond market had such a dramatic increase in rates over just a few months' time. It's that rate of speed of rate of change of policy that I think has really clamped down on the economy. I mean, all you have to do is look at housing. When a mortgage rate goes from 2.75% to 6% in a matter of months, of course you're going to impact. I mean, people were paying a lot of money for houses because they were getting money so cheap, and all of a sudden that cheap money went away.
Mm-hmm.
And it's not just housing, it's the refi. Refi was a big source of people
Mm-hmm.
spending. So I mean, that's totally gone. So I mean, I just don't think for some reason fed fed governors focus on that stuff. That to me seems like economics 101. And yet they seem to react to headline numbers. When the street gets all excited about a CPI number, they get all excited about a CPI. Excited meaning worried about a
Dave,
CPI
that's
number.
exactly my thought. Sorry to interrupt you here, but you hit on something that I think is key to understanding this that people aren't picking up on. The Fed reacts to the way that people react to them. It's almost as though there's this feedback loop. They do something, somebody does something else, then they got to do something instead of looking at the underlying fundamentals of the economy. Do you think that they're more worried about the perception of what's going on than what's actually going on? And do you think that that means that they know what the eventuality is going to be? Or have they just completely stopped looking at it? Because it didn't seem to me they were so shallow with their
Yeah, well,
rhetoric in recent years.
particularly they've got hundreds of economists. I mean,
Hmm.
it's not like they lack for data, right? Anything we can see, they see 10 times the amount. So maybe they get overwhelmed with the data and as a result ignore it and pay attention to
Hmm.
the noise out there.
Right.
Certainly it's a political situation. I mean, I'm sure he's hearing from the Biden administration, but
Yeah.
it's not
You got
like
midterm
Biden.
elections coming up, so that's always a
Yeah.
big thing during an election
Yep.
year for
I mean,
sure. Yeah.
Elizabeth Warren was on yesterday slamming. I actually, for once in my life, I think I agreed with her that they were going too far. But,
Hmm.
but so it's not like um, they don't have data. But I think yes, they're way too tuned into the street and the noise. And I will say this isn't the first time. For a long time, back in the 2008 2009 period, and ever since, have said we wouldn't have had Lehman if Paulson hadn't listened to the street.
Hmm.
The street spent many months after Bear Stearns saying, "Don't do another one. That's you're going to cause moral hazard." Right? Paulson did what the street told him to do, and then they got mad at him when everything fell apart, or they blamed him. He was stupid enough to think the street knows what they're doing. You know, we know better, right? We know the street oftentimes gets things wrong. But
Hmm.
I think Powell's making the same mistake as saying Wall Street knows best, and they're telling me I got to do this. How many voices are out there telling him he has to hike rates another 200 basis points, or you know, all that? And I think again, another thing I would say is that we're paying the price for Powell being an attorney, not an economist, and for most of the governors, and this is new, but most of the governors being academics, they they don't have that street savvy to know that, hey, just because there are a lot of voices out there saying this, the consensus on Wall Street is oftentimes wrong. So I think they are listening to way too many voices.
I think so too, and I think we have to tie in the Fed and their own trading, because if you look at that link with Wall Street, the Fed traded stocks and certain issuances and sold them around policy. I think that became pretty clear in terms of the lines of questioning. So the Fed is not 100% independent agency. They had something to gain by what the market was doing. I don't know if I go as far as to say that they were engineering the market just for their own personal gain, but certainly they stood to gain from that. So maybe they're too close to this street, Dave. Maybe they have too many connections, and maybe they're too well invested in it themselves, that it's hard for them to serve in an independent capacity. I think that's part of the problem, is everything's becoming financialized, and it's hard to have an independent agency to run a central bank now, because everybody's focused on the market, right? If everybody's
Yeah.
focused on the market, you're going to get into that, and that becomes part of the blood of the central bank. And maybe they've just lost that focus.
Yeah, I would say, and I've gotten this on Twitter a lot, I am not one in that camp that feels that there's an association between what Powell is doing and what, you know, those governors were doing. I think they made a huge error, and it was very wrong to be trading. I was shocked when I found out that's what they were doing. I mean,
Right.
you know, I thought that was all pretty much against any contract they signed there.
Right.
But I don't go take that the next step and say the Fed, you know, was operating as, you know, the reason they're making their mistakes is because they're doing things for themselves, or the reason they're doing what they're doing now is because they can't trade their own now, or whatever. I don't think that has anything to do. I do feel Powell is sincere in what he's doing. I think he's trying his best to do what he's, you know,
I do
what's
too.
right. What I say often is he doesn't understand, and again, this is new to him or unique to him, but he doesn't understand the leads and lags to policy. So he's focused on policy and the reaction to that policy today, whereas, you know, a true economist is understanding that that policy will have manifestations 3 and 6 months out, you know, and maybe longer. And so if you're going to wait until you see the results of your policy, you've way overstayed your welcome.
Yeah, and talking about manifestations of policy, you've said in this Twitter thread that we started off the conversation talking about, that you believe bonds are going to go back into a bull market mode. And certainly there's been pressure on them. We've had a yield curve inversion between the 10 and 2 year. We've had rates rising. You think bonds are going to improve. Can you explain why you think that's the case?
Sure. And I will say specifically treasury bonds. You know, I think all bonds will rally in the melt up that we'll talk about, you know, the equity melt up. But I think the treasury bonds are the ones that can keep going beyond that. And so I think we've seen the highs in rates. I've been saying that for a few months now. I think the 350 on the, or close to 350 on the 10-year was the high. And we're now down to 275. I expect by the end of the year to be at 2%, maybe even below 2%. And next year, in a global bust, which is the extension of this recession, it's something much worse. I think you're going to see a 0% 10-year, probably a quarter to a half on the 30-year. And I actually think the 10-year is probably going to go into negative territory. As much as the Fed hates negative rates, they're not going to have a choice next year. The reason I'm so bullish on treasuries is because it will be, number one, it'll get the benefit of a Fed pivot, or, you know, if the Fed pauses on rates, and if it pivots, you know, we'll see the bond market rally on that. But then beyond that, it will become the place to run and hide, the place for safety when the equity market's going through a bear market and all assets are pretty much tumbling because of a global bust. I use the term global bust to describe something that I think is going to be worse than 2008-9, and particularly worse overseas. You know, our banks are in better shape this time, so it may not be worse there, but in all other aspects, or many other aspects, I think it's going to be a worse downturn than 2008-9, which means the worst in the post-World War II era, and I think probably and the worst since the Great Depression. So, you know, we're heading for something very bad. That's not this year. I think it's a recession this year that moves into something worse next year. And so, you know, treasury bonds are probably the one asset, because of the government guarantee, And because that bust, I think, is going to be deflationary, it's one area where people can actually see appreciation during what I think is going to be a tough time for everything else.
Yeah, we'll talk about the melt up in next year here in a second. I want to go back to bonds for a moment, because a lot of people see bonds as getting worse. They see this a reversal of the 40-year bull market in bonds here in the US. We're talking treasuries, so let's just say treasuries. And they're concerned that all the de-dollarization, the dumping outside of the US is going to negatively affect bonds and maybe have to drive up yields to get people to buy them. However, what you're saying is there's still going to be that flight to safety trade, as the market fundamentals worsen. Can you explain, is it possible in a world in which a lot of the bonds are being dumped around, not all of them, but a lot of the bonds are being dumped, there's some de-dollarization pressures around the world in which the bonds could improve? Is this a temporary phenomenon? And do you think that Wall Street eventually will move away from bonds? Or do you think this is like the last push into bonds for safe haven status for a while?
Yeah, this is certainly going to be, I think we're coming to the end of a 40-year bond bull market. And I think what comes on the other side of the global bust will probably be in 7 or 8 years. I think we could reverse 40 years of declines in rates. So you could be back at 15% long bond by the end of the decade. That's a huge move. I mean, obviously.
Yeah.
So I think this is that final flush in rates down to, levels nobody could ever believe we'd see, because I think we're going to go, everybody's worried about inflation right now, but I think we're going into deflation next year because of how bad the economy is. And that's the other thing is, not this year. Again, there's a supply demand thing where if foreigners are selling, if China's selling or Japan is selling, that certainly adds to the supply and takes away from demand. But I think there's going to be enough demand because because the economy's going into recession. There'll be enough domestic demand. But the Fed may, I don't know what's going to happen in the latter part of this year, in the last several months of this year, in terms of QE. They seem to be wanting to do QT. So I'm not going to assume we're going to see a Fed pivot to QE all of a sudden before they even start QT. So we could have some QT this year, but I think the demand coming from a weak economy, demand for bonds coming from investors in a weak economy will more than offset that. Next year, during the global bust, next year, I expect the Fed's balance sheet to expand from 9 trillion to 30 trillion. So there'll be plenty of demand for bonds. Now, there's also going to be plenty of new supply of treasuries because it's going to be accompanied by a lot of fiscal expansion, but that's why I think you can get to 0% 10-year, is that
sure you could with that demand very easily. You could.
Yeah. If we, and the reason I say something as outrageous as 30 trillion is I think we're going to have a free falling financial system around the world because of a lot of policy mistakes that are being made. And because of what the pandemic did to make all economies fragile, and what the dollar did to emerging market debt this year, or emerging market economies this year, there are just so many things coming to a head here in the next year that I think lead to a financial crisis unlike any we've seen in history. And the one thing I can say is more predictable than anything else I predict is how central banks will respond to that. They don't have a choice, right? They will have to print money like there's no tomorrow because it has to be done fast, has to be done in size. We will see money coming out of every central bank at levels far beyond what we saw in the last 2 years. And so that's why I think you have one last flush in rates before you begin a big inflation cycle, far beyond this one.
And I know none of us really like to call timeframes because we don't control the information, and there are millions of economic decisions made every day. I follow milestones, right? And I just follow the milestones and say, okay, now we're into this stage, we're into this stage. But how long do you think potentially this plays out before you get that deep crisis and then the central banks respond by reversing course and saying, we got to open the spigots? Is that something that's probably going to happen in the next couple of years? And the reason I ask is just because people are going to want to prepare. People listening to this are going to say, okay, what do I need to do to get my financial house in order? And I kind of wouldn't want to give them like a rough time frame, if at all possible, even though I know it's hard to call specific dates.
Yeah, I get myself in trouble all the time because I pin myself down to tighter timeframes than I should. But I really do think It could stretch out, certainly, if
Yeah.
if the Fed pivots here, it could stretch my scenario out. But I basically have been saying the global bust will, the second level of this economic downturn, which is a global bust, will happen in 2023. And I think the Fed will respond in 2023. So I think the bulk of that money happens between early next year and mid 2024. So it's a 12 to 18 month time horizon where I think you'll see that kind of expansion in money. And then the lag to when that becomes an inflation cycle is probably pretty quick because of what we just had, what we're
Right.
dealing with now. So yeah, we go from inflation that's a worry right now to, I think, deflation very short term next year. But I think we come right back out of that because of the massive money. And by, say, 2025, we're already moving into, pretty good inflation levels, primarily because of commodity prices. I think, I have a forecast that by the end of the decade, we'll see $400 crude oil, WTI. So,
Mm,
I mean, and, copper could be, up from something now to $20 or $25. I just think commodities are going to go through the roof. For what we're seeing here in this last, year is kind of a microcosm of what I think is coming in a much bigger way in the 2024 to 2030 period.
yeah, I kind of thought somewhere in the middle of this decade things would start to hit the fan in terms of it would become really apparent. And I think it is now. I think it's apparent of the economic issues, but I think it's going to start to affect the currencies and the central banks and the debt. I think somewhere middle of this decade, hopefully that calls right. You never know, but it
Right.
seems like things are kind of aligning for that. So talk about what happens after the bust. You've talked about melt up and money printing and things like that, and specifically related to the metals, because the metals right now, gold and silver, have not reacted, to what's going on. They've sold off a bit. They're better off than a lot of the other asset classes, but it's not like they're rising right now. They're basically in a slow, moderate decline the last month. When do metals go up? Does it take that big melt up to occur before people say, okay, it's time to rotate in? Or do you think we may get some of that before then?
Yeah, I'm pretty bullish on the metals here, and it's been a disappointment and a frustration for the last 2 years, really. From that August 2020 peak, they just really have been frustrating ever since. They
Right.
started to come alive a couple times in there, and certainly early this year. And as you say, they've outperformed equities, but not in a good. It's just because equities were so weak in the
Right.
first half of this year. But I do think gold and silver. I think gold bottomed last Thursday. Came down on a log chart right down to the long-term trend back to 2001. So and another shorter trend line. So I think gold bottomed at 1680 last week, and I think is going to have a big move. I'm calling for 3000 still before the bust. So during this next 6 months, let's say 6 or 9 months. But and silver is a little harder because, as you know, it's much more economically sensitive, and we're going into a recession. But I think it's going to, just like stocks, look over the trough. So I think you can get silver. I'm still sticking to a $50 target for pre-bust, and then in the bust, gold maybe comes back. I don't know if it comes from 3000 back to here, but could, or back to 2000, something like that. Silver can probably get hit a lot harder. So silver, let's say it does get to 50, could come all the way back. I mean, it's because of its economic sensitivity. So it's not a straight line from here to post bust. Once you get beyond the bust, I think gold and silver become the assets of choice among all assets. So a lot of commodities will do well. Gold and silver will lead the parade. I think, gold, I don't know whether it's 10,000 or 20,000, probably in excess of 10 for sure, by the end of the decade. Silver, I think, can get to 400, and maybe that's low. So there's big numbers in terms of, even though I think the equity market in the melt up this year will put in a secular top that doesn't get seen again for decades, multiple decades. Commodities have a big bull market ahead. they are not near a secular top. They're in a whole different cycle.
Yeah, it sounds to me like you were earlier a few minutes ago that you were talking about a commodity bull market. I think you just kind of called one. How does that commodity bull market respond? Because base metals are up, energy's up, zinc, copper, lead, even to some extent. That what had a lot to do with restarting the economy and I think pent-up demand and supply chain issues. But there are longer term needs, especially for things like copper and energy commodities for these emerging economies, India, China, so on and so forth. Then you've got the Middle East. And then you've got, I see, David, is Africa sort of emerging. You've got countries down there looking to develop them. Of course, it depends on how good these African countries are at managing their own economies versus being, I'll say, colonized in a way, economically colonized.
By
They
China?
have to maintain their independence. Yeah, you don't want China to go and take them over like the British and Americans have done over the years.
Yep.
But I do see this tremendous demand for commodities. Do you think that commodities can still go up even if we're in the middle of a deflationary bust, or what does that look like to you?
Yeah, I don't think so. I think that's what I meant before by saying it's not going to be linear. You're going to have this run here. So and even the the lumbers and the coppers that have come down so hard in the last few months, I think they have another run. I'm still thinking copper might go to new highs. I'm using $6 up from $3.50 or wherever it is now, before the bust. Even though the economy is weakening, I think there's enough demand out there and short supply that if markets start thinking the wind is at our back with the Fed, I think it's going to cause commodities to run. So lumber can get back over 1,000, things like that. It's not going to go back to its highs because housing's been hit, but it could have a rally from 500 to 1,000. So I think you do have a mini commodity run here before the bust, but in the bust, I think commodities get hit really hard because everything, the economies are all around the world are going to be very weak. So, demand's going to disappear. So I think people have to beware, because a lot of people say, well, commodities, it's a big cycle. I'm going to just hold them. And I think you can be surprised at how weak they can get next year. And then, post, let's say by the end of 2024 or end of 2023 or early 2024, you'll begin the true commodity cycle or the next leg, which is going to be the big leg. And I think they're just, it's across the board. It's ag commodities, it's metals, it's, energy. I think the sky's the limit in terms of how far they can go. And part of the demand is what you said, certainly EV is going to be a demand for copper and other, metals. You're going to have, I think, the big fiscal expansion will be infrastructure oriented, whether it be power plants, whether it be, it's just going to be infrastructure across the board, and it's not just roads and bridges. So I think you're gonna, and this is going to be around the world. I think there's just going to be infrastructure demand. That means commodity demand, and as you know, it takes forever to build a plant or develop a mine. We're just not going to have the supply to meet the demand.
No.
And so the prices have to go through the roof. I mean, we're seeing a microcosm of that now. I think it's only going to be exacerbated after the bust.
Yeah, David, so much of what you and I do and a lot of market analysts do is we look at things as they're happening in time, but we look at it historically, and history really teaches us a lot, and things don't always repeat exactly. A lot of times they rhyme, or you can get clues from the past. So we appreciate the fact that you've studied the markets for so long and are providing sort of a wider term view of what's going to happen. Last question for you. I'm going to leave this open. Any last words of wisdom for the viewers on what's coming ahead? Anything that we haven't talked about?
Yeah, because we really didn't talk about the melt up. Let me just kind of fill in the blanks there and say, I really do think we've seen the lows of this correction in the stock market. And as I told you before the talk, I think there's a chance, there's a potential setup where you could see the S&P run to 4150 or thereabouts, in the next few days, and then pull back to 3,800. It doesn't have to happen. It's just a possible setup. That's the only thing in the way of, I think, this melt up really getting going.
Okay.
So you either have one more step back and then go, or you just keep going here. And I believe whether it takes 3 months, 6 months, or 8 months, it's something in that time frame. I think you'll go from where we are now on in the market, S&P 4,000, NASDAQ under 12,000. I think you'll see S&P up to 6,000 and the NASDAQ up to 20,000, the Dow up to 45,000, the Russell up to 3,000. Those are huge moves, probably unprecedented if they happen in that kind of time frame. What I call a final parabolic blow off or melt up into a secular top that I think that secular bull market started in 1982. And that was when disinflation really started and was the wind at the back of a bull market in stocks. So I think we are putting in a very major top either late this year or early next. And again, there'll be places in the market beyond the bust, after the bust, commodity producers, industrial stocks, lots of things like that will go way beyond their highs. But the indexes, I think, are seeing highs that they will not see again for decades. So I think it's really important for people to understand that indexing worked very well in the last 40 years because of lower interest rates. If we get into an inflation environment that pushes interest rates back from 0 to 15% or thereabouts, you're going to have PE multiples contracting, and it's going to make it impossible for the indexes to move forward to any extent. So then it becomes much more of a active manager, stock pickers environment.
Yeah, maybe the end of the passive investing that we've all been so spoiled by for so long, and actually require some people to actually get out there and do some research and homework and not just throw the money at one of these index funds.
And the thing is, as you know, those trends, the winding up to 40 years, the unwind will take a lot less than 40 years, but it's going to play out over several years. It's not going to, people aren't going to all of a sudden abandon indexing. So those that can understand it early can save themselves a lot of pain.
Yeah. David, thank you so much for coming on the program. How can people find you if they're interested in your information? The reason I say this is you had a very, very popular service on Twitter, and as well as your own information that you put out. How do they go about reaching out to you?
Sure. Yeah, I'm on Twitter every day at 𝙂𝙊𝙇𝘿. And you have to kind of put up with the trolls. There's a lot of, I'm a contrarian, so there's a lot of people that disagree with me on there. So just understand it's not, I've got plenty of silent followers that I think like what I say, but you wouldn't get that flavor from the people that post. There's lots of criticism, but anyway, 𝙂𝙊𝙇𝘿 at 𝙂𝙊𝙇𝘿 is my Twitter handle. And I also put out a quarterly investment letter by subscription, which means it's, for a price. If people are interested in that, just direct message me on Twitter and I'll provide you details. It's the only thing outside of Twitter that, I can kind of present my longer view like I do on the interviews.
Right. Well, thank you so much, David, for joining us back on the program. We appreciate it. And I think we're going to have a lot of fireworks going on the next few years. So definitely we want to have you back on to help us walk through that and explain to the viewers what's going on. When we get into market cycles like this, people, I think, are going to panic. I'm starting to see it already. I'm starting to see a lot of emails about what should I do, portfolio planning, stuff like that. And I'm not an advisor, but I think people just want to know what's going to happen, and get a realistic view. I don't think you see it in the mainstream media that much, which is why, I love it, the fact that you're on social media, giving your take on what's going to happen. And I think that provides information people aren't going to get anywhere else. I appreciate you doing that.
Yeah, thank you. Yeah, it's a guideline. As I say, I'm not an advisor. I'm not a financial advisor either, so I can't give advice, but I can provide a forecast that gives you some kind of a guideline of what's coming. And then you got to figure it out for yourself or get an advisor and go from there.
Sure.
But yeah, thanks for having me on, Rob.
Yeah, anytime. All right, we'll speak to you next time, David.
Okay, take care.